Let me start with something most traders never admit out loud. You have spent months studying charts. You understand support and resistance. You know what liquidity means. You can read a higher time frame bias. You have a strategy that makes sense on paper. And yet, the moment price moves against you by a few pips, something happens inside you that no indicator can measure and no backtesting can prepare you for. Your hands start moving on their own. You close the trade early, or you add to a losing position, or you revenge trade, or you just sit there frozen, watching your stop loss get hit while you debate whether to move it. That is not a strategy problem. That is not a knowledge problem. That is the real war, and it happens entirely inside you. Picture a trader. He is not sitting at a desk looking at charts. He is in the middle of a battlefield, lifting heavy weights. His muscles are shaking, his breathing is heavy, but he keeps going. The weight in his hands is not iron. It is his trading plan. Every rule he has written, every risk parameter he has set, every entry criterion he has defined. He is carrying all of it, every single day, with discipline. Now on the other side of this image stands a figure. This figure is not holding a weapon. It is not physically stronger than the trader. It does not need to be. It is holding a single feather, and with that feather, it is touching the trader's shoulder. That figure is emotions. This is not just a metaphor. It is an exact description of what happens in trading every single day. The market does not beat you with force. It does not overpower you with complexity. It finds the one crack in your psychological armor and applies the lightest possible pressure. A small floating profit that makes you greedy. A trade going slightly against you that plants a seed of doubt. A losing streak that turns impatience into revenge. None of these require a dramatic market event. A feather is enough, and that feather has ended more trading careers than any black swan event ever will. Most traders treat a trading plan like a checklist. Entry here, stop there, target there. Done. That is not what a trading plan is. A trading plan is a system for removing your present moment emotional state from the decision-making process. That is its entire purpose. Every rule in your plan exists because at some point, a trader in an emotional state made the wrong decision, and a rule was created to prevent that from happening again. Risk management rules tell you exactly how much you lose on any given trade before the trade begins. You are not calculating this in the moment when your hands are shaking and you are wondering if this is the setup that recovers last week's losses. You calculated it when you were calm, when you were not in a trade, when your prefrontal cortex was running the show instead of your amygdala. Entry rules define the specific conditions under which you take a trade, not because it looks good, not because you have a feeling, not because someone in a trading group said it is a high probability setup, because your defined criteria are met. Full stop. Stop loss discipline means your stop goes where your analysis says it should go, not where your emotions want it to go, not slightly further because you are convinced the trade will come back, exactly where your plan says it goes. Journaling forces you to confront the relationship between your emotional state and your trading decisions. Every trade logged with the context of what you were feeling forces you to see patterns you would otherwise never notice. You will discover that you take your worst trades on days when you are frustrated. You will see that your best trades happen when you are bored, not excited. None of this is visible without the journal. These four elements together do one thing. They build what is best described as a trader's mindset, not knowledge, not technical skill, mindset. The structural capacity to act on your plan regardless of what you are feeling in the moment. This does not happen overnight, and it does not happen because you read about it. It happens through repetition, exactly the way physical strength is built. Nobody walks into a gym on day one and lifts the weight they will eventually lift in year 3. The process does not work that way. You start with what you can handle. You are consistent. You fail regularly. There are sessions where you feel weaker than the last time. There are weeks where progress seems invisible. And then, one day you are lifting something that would have been impossible 6 months earlier, and you cannot point to the exact moment it changed. Trading plan discipline works the same way. In the beginning, following your plan feels unnatural. You have a trade that hits your entry criteria, and you take it. Price immediately moves against you. You close it before the stop. It reverses. Then it hits the original target. You lost on a trade that should have been a winner because you deviated from the plan. That happens. It happens repeatedly, and it creates a psychological loop where you start to doubt whether the plan is the problem. It is not the plan. It is the muscle that does not exist yet. Following a plan under pressure is a skill. It requires a part of your brain that most people have never trained. The part that holds the course when everything feels wrong. The part that executes a stop loss without hesitation, even though it hurts. The part that does not add a position just because price is moving beautifully and you suddenly want more. Every time you follow the plan when you did not want to, that muscle grows. Every time you deviate deviate because the emotions won, that muscle atrophies. Over months, traders who consistently follow their plan build something that cannot be copied from someone else's strategy. They build execution consistency. And execution consistency is what separates the traders who last from everyone else. The figure with the feather is not random. Each touch is a specific emotion, and each one attacks differently. Fear is the first, and it attacks the earliest, usually right after entry. The trade is open. You are in profit by a small amount. Fear tells you that this profit can disappear. It whispers that the market is unpredictable, that you have been wrong before, that taking something is better than taking nothing. So you close the trade at a fraction of your planned target. You took a trade with a solid risk reward and turned it into a fraction of what it should have been because fear convinced you that was wisdom. Do this consistently and your risk reward ratio collapses. Even if your win rate is decent, your account slowly bleeds because you keep cutting winners short. Greed is the second. It usually appears after a few winning trades. You are feeling good. Confidence is high. A trade sets up and everything looks perfect. Greed says the target is too conservative. Greed says to hold longer, take more. This is the move. So you do. And the market reverses. The profit you had is gone. Sometimes the trade turns into a loss. The irony is that greed does not feel like greed in the moment. It feels like confidence. It feels like conviction. That is what makes it so dangerous. Revenge is the third and arguably the most destructive. You took a loss, maybe a string of losses. Something inside you shifts from trading to fighting. The market is not an entity with intentions, but in that moment it feels personal. Revenge says the next trade will recover everything. Revenge says to size up, move fast, find a setup right now. The trades taken from revenge are almost never setups. They are reactions, and they compound losses in ways that can take weeks to recover from, if recovery happens at all. Doubt is the fourth. It is quieter than the others and works over a longer time frame. It creeps in during drawdowns. Your strategy stops working for a few weeks. The doubt starts asking questions. Maybe the market has changed. Maybe you never really understood it. Maybe this approach was always flawed. Doubt makes you tinker. You start adding indicators. You start changing rules. You abandon a strategy that needed more time and consistency, not replacement. And you reset the clock on your own development every time. All four of these share one characteristic. They take you out of your plan. They make you trade your emotional state instead of your rules. And once you are trading your emotional state, you are no longer a trader. You are gambling with a chart in front of you. There is a persistent myth in trading that profitable traders are special, that they have access to better information, better strategies, better tools, that they see something in the chart that losing traders do not see. This is almost entirely false. The strategies used by consistently profitable traders are not secret. Most of them are available in books, courses, and free resources. Supply and demand, liquidity, structure, risk management principles. None of this is hidden. What is different is what profitable traders do when they are in a trade. They do not feel less. The fear is there. The temptation to hold longer is there. The frustration after a loss is there. They are human. The difference is that they have trained the gap between feeling something and acting on it to be wide enough that the plan can still execute cleanly. A profitable trader feels fear, then executes the plan. A losing trader feels fear, then closes the trade early. The feeling is identical. The response is different. And that response difference is entirely a product of how much psychological training has been done. Profitable traders also have a specific relationship with losses. They expect them. They budget for them. A trader with a 50% win rate, running a solid risk-reward ratio, knows that losing trades are part of the model. They do not mean the strategy is broken. They do not require immediate recovery. They are the cost of doing business. This framing is not automatic. It is built deliberately by studying your own statistics, understanding the edge your strategy actually has, and repeatedly experiencing that losses within your system do not prevent profitability over time. This is why journaling is not optional. Without data, you are flying blind. With data, you can look at a large sample of trades and see that your strategy has a genuine edge, that your biggest losing periods were caused by specific emotional behaviors, and that when you followed the plan without deviation, the results are meaningfully different. That data changes how you relate to losing trades. It makes staying in the plan easier because you have proof, not just hope. Every session starts the same way. You open the chart, you check the higher time frame bias, you identify the key levels, you wait for your setup conditions to form. So far, this is purely analytical. This is the plan in action. Then price starts moving, and the forces that were described earlier arrive uninvited. Your strategy sits in one corner. Your patience sits next to it, slightly nervous, and your emotions walk in through a door that has no lock. The question is never whether emotions show up. They always show up. up. The question is whether you have built enough structure around your decision-making that the emotions cannot override the plan. This structure is what separates a trading session from a gambling session. It is not the chart. It is not the strategy. It is the internal governance system you have spent months building through disciplined plan execution. Some days, it holds perfectly. You follow every rule. You take the stops without hesitation. You let the winners run to target. You close the session with your self-respect fully intact regardless of whether the day was green or red. Some days the emotions win around. You deviate. You recognize it either in the moment or in the post-session journal. You note what happened. You note how you felt. You note the cost of the deviation. And then you go into the next session determined to be better. This is the process. It is not dramatic. It is not exciting. It is repetitive, incremental, and unglamorous. It is also the only way it works. The industry profits from the belief that trading success comes from finding the right tool, more indicators, better signals, a premium strategy, an exclusive group. There is always something new to buy that promises to be the missing piece. This belief is comfortable because it places the problem outside of you. If you just had the right information, you would be profitable. The problem is external. The solution is external. The actual truth is the opposite, and most traders resist it because it is harder. You do not need more indicators. Every indicator is a derivative of price. If you understand price, the indicators are redundant. If you do not understand price, the indicators create noise, not clarity. You do not need more signals. More signals mean more decisions. More decisions mean more opportunities for emotional override. Fewer, higher quality setups that you execute consistently outperform a high volume approach executed emotionally every single time. You do not need a secret strategy. The strategies that work have been publicly available for decades. The traders who fail using them are not failing because the strategy is flawed. They are failing because they cannot execute it consistently under emotional pressure. What you actually need is the capacity to follow your plan when the emotions are loudest. Not when trading feels smooth. Not when the market is cooperating. When it is hard. When you have just taken 2 losses and the next setup is forming. That is when the muscle matters. You need the courage to accept a loss without needing to immediately recover it. This is not passive or weak. This is one of the highest difficulty emotional skills in trading. Accepting a loss cleanly and waiting for the next valid setup requires a level of ego detachment that most people have never been asked to develop in any other area of their life. And you need the habit of consistently ignoring emotional impulses while in a trade, not suppressing them, ignoring them as inputs for decision making. The emotion can exist. You can feel afraid. You do not have to act on it. Building that habit requires thousands of repetitions. It does not arrive from reading about it. Success in trading is not defined by win rate alone. A trader with a lower win rate running a solid average risk reward is more profitable than a trader with a high win rate cutting every winner short. Success is defined by the relationship between how much you make when you are right and how much you lose when you are wrong, sustained over a large sample of trades. Sustaining that relationship requires one thing above everything else: consistency of execution. You cannot have consistent execution if your emotional state is controlling your decisions. The trader who holds winners through discomfort because the plan says to hold produces a different result than the trader who closes early because fear made the decision. The trader who exits at the predefined stop loss produces a different result than the trader who moves the stop and takes a larger loss. These are not rare edge cases. They happen in almost every session for traders who have not developed emotional discipline, and they quietly destroy accounts that would otherwise be profitable. The successful trader is not the one with the loudest confidence or the most impressive setups on paper. The successful trader is the one who is calm when there is a reason to panic, disciplined when there is a temptation to deviate, and consistent when inconsistency would feel more comfortable. Loss does not rattle them because they have already accepted that loss is part of the model before the trade was even entered. Profit does not inflate them because the next trade requires the same disciplined execution as every trade before it. Plan first, always. Feelings second, noted and filed, but never driving. Discipline in trading is not a destination. It is a daily practice. There is no point at which you have enough discipline that you stop needing to practice it. The emotion will always show up. The market will always find new ways to create pressure. The feather will always be there. What changes with time is your relationship to it. In the early stages of your development, that feather feels like a sledgehammer. Every emotional impulse feels urgent. Every deviation feels justified. The plan feels like a constraint rather than a tool. With time and consistent practice, the feather starts to feel like what it actually is: a light touch, an invitation to deviate that you have learned to recognize and decline, not with force, with familiarity. You will have seen this before. You know how this ends if you follow the emotion. You have the journal entries to prove it, so you acknowledge the feeling, set it aside, and execute the plan. That is not suppression. That is maturity. That is what the gym was building toward. Not the ability to feel nothing, but the ability to act correctly, even when you feel everything. Every day that you add small amounts of discipline to your sessions, you are making a deposit into a future that compounds. It does not look like progress in the short term. There is no dramatic moment where everything clicks. There is just one day, after months of repetition, where you realize that the trade you used to blow up on was executed cleanly, and then another, and then another. That is how this builds. You are not fighting the market. You never were. The market does not know your name. It does not care about your account. It is indifferent. You are fighting fear. You are fighting the impulse to take more than what the plan allocated. You are fighting the urgency to recover immediately. You are fighting the doubt that makes you abandon what is working. When you win that fight consistently, the market does not need to be conquered. It just needs to be engaged with discipline. And on the day that discipline becomes your default, not your effort, you will understand what it actually means to trade.